Greetings and welcome back to the channel. Andrew May here, investment advisor and certified financial planner professional, bringing you more real-world strategies designed to assist you in navigating your personal financial life. In today's video, I will be addressing the topics of volatility and risk. While it is common to hear these terms used interchangeably, they are not necessarily the same. I want to define them for you and offer my thoughts on how you should consider them in light of your investment management activities. But before we jump into the content, if learning more about personal finance and investing is something that's of interest to you, be sure to hit the like button and subscribe to the channel. So, let's first explore the topic of volatility in relation to one's investment portfolio. According to Investopedia.com, volatility is a statistical measure of the dispersion of returns for a given security or market index. A higher volatility means that a security's value can be potentially spread out over a larger range of values. This means that the price of a security can change dramatically over a short period of time in either direction. A lower volatility means that a security's value does not fluctuate dramatically and tends to be steadier. Volatility is often measured as standard deviation, which is a statistic that measures the dispersion of a data set relative to its mean. Where the higher the standard deviation, the more volatile the security or portfolio. As an advisor, I believe that it's important for an investor to own a portfolio that exhibits a level of volatility that they are comfortable with. Understanding that the greater the portfolio's volatility, the greater the potential return, and the lower the portfolio's volatility, the lower the potential return. The level of volatility can be managed by a portfolio's asset allocation, or the percentage of one's assets allocated to stocks, bonds, cash, or alternative asset classes. Now, let's look at risk, or more specifically, investment risk. Risk takes on many forms, but is broadly categorized as the chance that an investment's actual gain will differ from its expected return. Risk includes the possibility of losing some or all of an investment. There are several types of risk and several ways to quantify risk for analytical assessment. Risk can be reduced using diversification, asset allocation, or hedging strategies. When it comes to risk, there is a significant difference between making an investment in one stock or into a broadly diversified portfolio. An investor can suffer a permanent loss of capital when investing in one stock, but the odds of suffering a permanent loss of capital when investing into a broadly diversified portfolio is arguably non-existent, especially when considering that the U.S. stock market has recovered from all past corrections and bear markets. Therefore, the risk of suffering a permanent loss of capital when investing into a broadly diversified portfolio of securities has largely been non-existent for long-term investors who chose not to sell securities at an inopportune time. The true risk faced by investors who are asset allocators isn't so much experiencing a permanent loss of capital, but rather not having saved enough to achieve their financial goals, such as funding retirement. In summary, all investors experience portfolio volatility, and this volatility can be managed through diversification and asset allocation. When it comes to investment risk, rather than thinking of it as the chance at a permanent loss of capital, investors who are asset allocators need to realize that the real risk they face is not having saved enough money to achieve their financial goals. To me, as an advisor, that is the real risk, not suffering a permanent loss of capital, which is unlikely to happen to investors who are holding a broadly diversified portfolio for many years or decades. If you found today's video informative and thought-provoking, then be sure to hit the like button and subscribe to the channel. Also, if you know of anyone else who may benefit from the contents of this video, consider doing that person a favor and sharing the video with them. Until next time, I'm Andrew May, investment advisor and certified financial planner professional, and I believe that by keeping volatility and risk in proper perspective, you will be better prepared to do this.